When the paychecks stop, the anxiety starts because now you're the one in charge of making sure your money lasts. That's one of the hardest mental shifts in retirement, going from saving to spending. You've spent decades building your nest egg, and now it has to turn into a steady paycheck that you can actually count on. I'm Cary Green, financial advisor and co-founder of Green Era Financial, and I help people close to or in retirement to get the most out of life with their money. And today we're talking about how to create a retirement paycheck, one that's sustainable, predictable, and built to last. The first step in building a retirement paycheck is to know what income you can depend on no matter what happens in the markets. For most people, that starts with Social Security, and if you're really lucky, a pension. These sources form the foundation of your retirement income. They're steady, inflation adjusted, at least in the case of Social Security, and not tied to the ups and downs of your investments. Social Security was designed to replace about 40% of your pre-retirement income, but the actual percentage varies depending on your lifetime earnings and when you claim. The longer you wait, up to age 70, the higher your monthly check. That's why it's worth thinking strategically about when to claim your Social Security. Now, if you're part of the growing group of retirees without pensions, you may choose to create your own predictable income stream. That might mean allocating part of your savings to income-producing assets like bond ladders, treasury securities, or even potentially annuity structures that fit within your broader plan. The key is to identify what portion of your monthly expenses should be covered by income that doesn't depend on market performance. Now, once your essential expenses are covered by guaranteed income, the next layer is flexible income, withdrawals from your retirement accounts and investments. This is where most retirees get nervous because it's where sequence of returns risk and tax efficiency really start to matter. So think of this layer as your lifestyle income. It's what allows you to travel, remodel the kitchen, or help the grandkids. The things that make retirement enjoyable, but it needs to be managed carefully. A common starting point is the 4% rule, which suggests withdrawing 4% of your portfolio in the first year of retirement and adjusting for inflation each year after. But remember, that's a guideline, not a guarantee. In reality, your withdrawal rate should flex based on market performance, taxes, and your spending needs. For example, in strong market years, you might take a bit more. In down years, you might reduce spending slightly or use a cash reserve instead. This kind of adaptive withdrawal strategy can dramatically increase your odds of long-term success. So once you've got that covered, you know where your income is coming from. The next step is turning it into an actual monthly paycheck, one that feels just like what you had when you were still working. Now, one simple way to do this is to set up a monthly transfer from your investment accounts into your checking account. You can think of this as paying yourself. The idea is to simulate a consistent deposit every month so your spending rhythm stays the same. Behind the scenes, that monthly deposit could be made up of dividends, interest, and periodic withdrawals that are planned and tax efficient. The goal is to avoid big, irregular lump sums that make budgeting difficult and increase the risk of withdrawing at the wrong time. Now, some retirees use what's called a bucket or ladder system to organize this. Cash in short-term bonds for the next couple of years of spending, intermediate-term investments for the next decade, and growth investments for later years. That structure allows you to refill your short-term bucket during good markets and preserve your long-term growth during downturns. But here's a key thing. Even a well-structured paycheck can lose its power if you don't account for inflation and taxes. A dollar today won't buy the same amount 10 or 20 years from now. That's why part of your portfolio should stay invested for growth to outpace inflation over time. Taxes can quietly shrink your retirement paycheck if you're not careful. Withdrawals from traditional IRAs and 401ks are taxed as ordinary income, while Roth IRA withdrawals are generally tax-free. Coordinating which accounts you pull from each year can make a significant difference in how much you keep after taxes. For example, you might withdraw from taxable accounts first, then pre-tax accounts, and leave Roth account assets for later, or blend them strategically to stay in a lower bracket. The right sequence depends on your mix of accounts, income sources, tax thresholds, your goals, your time horizon, and what's right for your situation. Now, the final piece of creating a reliable retirement paycheck is to remember that your plan isn't static. Life changes, markets change, tax laws change, and your strategy should adapt with them. So schedule a review each year to rebalance your investments, evaluate your withdrawal rate, and make sure your cash flow still aligns with your goals. Having a plan that evolves with you is what separates confident retirees from stressed ones, and what we want is you to be able to sleep at peace at night. So, a great retirement income plan turns your savings into a steady, predictable paycheck without sacrificing flexibility. It's not just about drawing down your accounts, it's about building a system that funds your lifestyle for decades to come. And at Green Era Financial, that's exactly what we help clients do: design income strategies that are tax smart, sustainable, and aligned with your real life goals. So if you'd like help creating your own version of that plan, you can always reach out to me directly or visit us at greenerafinancial.com. I'm always happy to help if I can. Thanks for watching, and I'll see you next time.